Value investors often overlook Nvidia stock, and some even claim that it's a bubble. However, I think it's a mistake to outright dismiss Nvidia stock and the entire AI wave behind it. Nvidia is not all hype. It is a real business with real profits behind it. Just in this last quarter, Nvidia generated $16.8 billion of free cash flow. The growth of this company has been nothing short of insane. And yes, you see the stock price boom over the past 2 years, but it's a mistake to think that's divorced from the business reality. Nvidia has seen massive earnings growth in that time, and it's expected to continue growing from here. So although I do not think Nvidia is a bubble, I also wouldn't say it's necessarily a buy at the current price. I do not personally own Nvidia stock, so today I'm going to give you an unbiased analysis on the company. That will include a look at their latest quarter and earnings call, explaining the key factors that drive that growth, a bull and bear case for Nvidia stock, and ultimately my own discounted cash flow valuation for the company. Let's roll the intro. My name is Zach, this is Dividend Data. You should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I will be using the best stock research tool, dividenddata.com. And for you AI people, I just added a massive new feature to Dividend Data. You can now get access to your own personal investment research analyst powered by AI. Think of this as ChatGPT, but specifically trained for stock analysis. You can use it to summarize the latest quarters and earnings calls as they happen, like I will be doing with Nvidia today. You can value stocks with a discounted cash flow calculator that autofills with every company's data, plus understand all a company's key metrics driving their business. And that's just scratching the surface of what you can do with Dividend Data, let alone all of our other research tools. The best time to sign up is today, and we're doing a 50% off sale to celebrate the launch of our AI tool. You can get 50% off for life. Just click the link in the description and pin comment of the video. Or if you create an account via the web app, select your plan and enter the promo code AI at checkout. That's the 2 letters AI. So first, let's just take a step back and look at the big picture for Nvidia. They are currently priced at $146 per share. Over the trailing 12 months have had GAAP earnings per share of $2.54, which gives them a 57.7 PE ratio. So yes, that is a high PE ratio, but a big thing to factor in when valuing a business is growth rates. This is something a lot of value investors neglect. And that doesn't mean there's no risks for investing in Nvidia, because those future growth rates are very uncertain. Over the trailing 12 months, Nvidia has generated $56.5 billion of free cash flow. This is money that theoretically could be redistributed back to shareholders via dividends or share repurchases. Nvidia has an incredibly small dividend and does not signal that they want to become a high dividend growth company, but they have started buying back some stock lately. Right now, all this cash flow is being used to build a fortress balance sheet for Nvidia that is now up to $38.4 billion of cash and short-term investments, and the company is negative $28.5 billion of net debt. But one of the most impressive parts of Nvidia's business is how high margin their products are. In the latest quarter, they had a 74.56% gross margin, a 62.3% operating margin, and 55% net margin. If you analyze a lot of companies, you know how crazy these numbers are. But how does the business actually make money, and where is all this growth coming from? Virtually all of this increase in earnings and revenue is coming from their data center business. Just in the past 2 years, the quarterly revenue of that business has grown from $3.8 billion to $30.7 billion. Even if you're a bear on Nvidia and the whole AI space, you have to give respect here. This is one of the most crazy growth stories in the history of business. 3 years ago, the data center segment was less than half of Nvidia's business, and today it's 87.7% of their quarterly revenue. And that's while generating 7 times more revenue. Now I'm going to analyze Nvidia's latest quarter and their future guidance, and then after that, I'm going to provide provide the key risks around Nvidia stock, and that risk will come from looking at who Nvidia's customers are, because it's important to remember that Nvidia's revenue and profits are someone else's infrastructure cost. But first, let's take a look at their Q3. Nvidia reported record quarterly revenue of $35.1 billion, up 17% from just the prior quarter and up 94% year over year. And as I just showed, the entire story with Nvidia stock is the data center segment. So if we look just at that, it had revenue of $30.8 billion, which is up 17% from the prior quarter and up 112% year over year. GAAP EPS was 78 cents per share, which is up 16% from the prior quarter and up 111% from a year ago. Non-GAAP EPS was 81 cents per share, up 19% from Q2 and up 103% from a year ago. And they did beat across the board on both revenue and earnings per share, with a 5.89% beat from analyst expectations on revenue and an 8% beat on earnings per share. And by the way, these analyst estimates were higher than the guidance that Nvidia gave in the prior quarter. So they beat their prior guidance by a lot. Speaking of guidance, Nvidia said that they expected Q4 revenue to be $37.5 billion. And it's this number why the stock initially went down after hours, because Wall Street was expecting even higher guidance. However, in my opinion, I think Nvidia is just being conservative with these numbers. They do not want to get into a situation where they're too outlandish with their guidance and then they end up missing. Other guidance given was around gross margins. They expect it to be in the moderate to low 70s before their new Blackwell chip ramps up, and then it will return to the mid 70s when it is fully ramped. Speaking of Blackwell, that's their new AI system, which is just rolling out. They shipped 13,000 GPU samples in Q3, and on the earnings call, they cited that demand for Blackwell is described as, quote, staggering. Other highlights include Nvidia growing their inference use case. And these are basically the two major use cases for their AI data centers. You have training models, and then you have inference, which is basically the use case of running existing models. So for example, that would be asking a question on dividend data. Inference would be the use of a model. And I'll use this other highlight to pivot into some risks for Nvidia stock. Cloud service providers accounted for half of data center sales, more than doubling year over year. That includes AWS, Microsoft Azure, and Google Cloud. This is where we get into some of the risks. Nvidia's profits are someone else's capital expenditures, and these customers are the big tech companies. 18.9% of Nvidia's revenue comes from Microsoft, 10.1% from Meta, 7.8% from Supermicro, which buys the Nvidia GPUs to combine with their server cooling and racks, and then Supermicro sells those to customers. And that's the same with Dell coming in at 3.1%. Dell and Supermicro are basically middlemen that add a little service in between. And then you have Alphabet at 5.9%, Amazon at 5.4%, and Tesla at 2.1%. So the biggest use case is cloud service providers, which is Amazon Web Services, Microsoft Azure, and Google Cloud. And they are investing so heavily in this so that they can support the demand for all these other businesses to have AI and machine learning workloads. And here you can see the capital expenditures just exploding at these companies. Microsoft has nearly 3x their quarterly CapEx over the past 3 years. They are now spending $14.9 billion a quarter. And if we look at Amazon's CapEx by segment, you can see that AWS became the largest cost by far. That hit $24.8 billion in fiscal 2023. And by the way, this is going up. And in Q3, they spent $22.62 billion of capital expenditures. Meta spent $8.2 billion of CapEx last quarter. And Alphabet, which is Google Cloud, also is growing CapEx at $13 billion in the latest quarter. And the vast majority of this CapEx spend is going to Nvidia. They have a dominant position in parallel compute at the data center. Outside of cloud service providers, you have companies with data centers like Meta. As I mentioned, they are one of the biggest customers for Nvidia, and they use these chips to train their open source AI model. But then they also are regularly using AI internally to improve their existing business. That's through a wide swath of machine learning tasks, whether that's improving the recommendation algorithms on their apps or improving their advertising business, making sure that ads get better matched to people who will buy, which in turn makes their customers more money and more willing to spend on advertising. These are real world improvements from machine learning and AI. Then you also have very large enterprises using AI for applications such as autonomous driving. And that's where you get to Tesla's massive capital expenditures. They spent $3.5 billion last quarter, and that's to build and expand massive data centers for the purpose of training self-driving models. And this is one good example of a real-world use case. So Zach, what is the risk? The risk is that these companies don't get any return on their investment in the next few years. And if that happens, they may find it less rational to continue spending billions and billions of dollars on these AI systems. They may decide they have enough capacity or will upgrade less frequently. Nvidia's entire business is dependent entirely on the cost and capital expenditures of other businesses. Now, the good thing for them is that these are the most profitable businesses in the world with the best balance sheets. And the other thing Nvidia has going for them is that over the long term, AI will definitely have massive productivity increases in the world. And that's what all of these companies are betting on. And right now, the Microsoft CEO and the Google CEO are positioned with the mindset that there is far greater risk not investing into this AI infrastructure than the risk of overspending. And from their perspective, they are completely right. The upside is massive and there is big downside if they don't invest in it and then new competitors come along that crush them, or if they just miss out on an entire growth wave. And again, on the positive side for Nvidia, it doesn't seem like this spending is going to decrease in the next 1 to 2 years. Microsoft Azure grew 33% year over year in Q1 2025, and they are expecting Azure growth to accelerate in the second half of 2025. As long as these companies see growth and opportunity, they will continue to spend. As I will soon explain, Nvidia's entire valuation is based on the premise of growth. So not only do they need to stay at these profitable levels, they need to keep growing at a high rate for many years to come. However, if for any reason growth slows, or let alone declines, Nvidia stock will fall off a cliff. If growth stops, Nvidia stock could get cut in half. And that is the major risk to consider when investing in Nvidia. How likely or unlikely do you think that is? And then you have to balance that risk-reward ratio at the current price. All right, so let's do a discount cash flow analysis on Nvidia stock to estimate the intrinsic value, and then I'll provide analyst price targets and compare that to the current price. And if you want to follow along, this is all available at dividenddata.com. Just type in any stock and discount cash flow valuation, and then you'll get this calculator you can open up, which auto-fills with the company's financial data, and you can edit key points to change the calculation. So here you can see they're defaulting to 110% growth for fiscal 2025, which is accurate, 47% growth for 2026, which may be on the low side, and 20.9% revenue growth for 2027. So I would say this defaults to an extremely conservative estimate, especially since they're considering 0% growth in 2028 and 2029. And this also assumes that by the end of fiscal 2025, they will be trading at a 34.45 free cash flow multiple. So that would give it an implied share price of $100.32. That signals 31.23% downside. However, as I mentioned, I think this is a conservative estimate for Nvidia. But to give an even more bearish outlook, let's assume they have a 20% decline in fiscal 2029. And that could be from a decline in spending among these cloud providers, which I discussed as a key risk. If that happens, it lowers the implied share price to 82.74. That would be negative 43% downside from the current price. But let's go to what I think is actually the most likely outcome. I think they're going to beat this growth rate in 2026, so I'm going to put that at 55. And in 2027, I'll put it at 30% growth. And then for 2028, I'll put it at 20, and again at 20 in 2029. So I would actually say this itself is pretty realistic, and that puts it at $372.8 billion of revenue in fiscal 2029. So I would actually say this is somewhat realistic, and it's definitely possible to have a more bullish outlook than this. And I do think a 34.45 free cash flow multiple for a company like Nvidia, which then would be growing at 20% and still likely have 70% gross margins, I do think that's a reasonable multiple. And that would make the implied share price $157.52, which implies 7.97% upside from the current price. But as I mentioned, there is a lot of future uncertainty with Nvidia's growth rates. If at any point it sees a decline, this stock is going to tank. And it's for that reason that I am not investing in Nvidia stock, because I don't see the risk reward at the current price. However, if you bought the stock many years ago, I also wouldn't sell it either. That said, Wall Street analysts are bullish on the stock with the mean price target at $165.51. That would make it about 14% undervalued. The highest price target is $200, which implies significant upside. And the consensus recommendation score on a scale of 1 to 5, with 1 being the most bullish, is 1.28. So Wall Street is still very hot on Nvidia. But I want to reiterate that a lot of high future growth is already priced in for Nvidia stock. And if at any point growth slows or let alone declines, the stock is going to do terrible. Everything about the company is predicated on growth. I do not own Nvidia stock. I'm not buying it at the current price, but it is undoubtedly an extremely high quality business, and I think deserves to be up there as one of the most valuable companies in the world. Nvidia stock is not a bubble. It definitely has risks, but it's a real business. If you enjoyed the video, please leave a like, comment, and subscribe to the channel. And most importantly, if you found the stock research tool I use throughout to be compelling, then sign up at dividenddata.com. Today is a great time to join because you can lock in 50% off for life. And that gives you access to my AI investment analyst and full stock analysis tool I showed throughout. This can save you a lot of time when researching. Plus, if it helps you find just one better stock, then it more than pays for itself. Click link in the description and pin comment to get the deal right now. Or create an account on the web app, select your plan, and enter the promo code AI at checkout. Thanks for watching, and I'll see you in the next video.